Hello from the children of planet Earth.
What's up, everybody? Good morning. Sorry for the late start. Skip all the usual intro stuff. Resetting up my platform here.
Hello from the
We're
children.
opening in 1 minute. What's up? What's up? What's up? Good morning. Hit that like button, you guys. Y'all know the drill. Oh, shoot. 8:30. Just starting. All right. Looks like we're trading box. Here. Save my layout. All right, inside of DD bands. Ooh, Nasdaq's negative. Let's watch that for a little bit. Today we got consumer confidence in 29 minutes, home sales, existing home sales in 29 minutes as well. It's kind of like wait for those to come out. That'll give us some time to go by. VIX inside of liquidity pocket, nothing going on there. Here, turn off, go there. All right, liquidity pocket, S&P, probably DD ratio is probably good. But I'm saying probably a hedge pressure bounce. I'm gonna let this pull back a little bit and take a long. Still same setups as we've had before. You guys, sorry about that. All right. Check out QQQ really quick. Yeah. So breaking bull side would be one type of trade that I would look for. Trade up to DD band. It's pretty much similar setup as we've had for the last. Give me 1 second. No action yet. No activity yet. Load up my thinkorswim here. Okay, gonna wait on that. Let's look at QQQ. Same thing. Similar MHP. I'm gonna save my settings here. We're long up on QQQ, so still looking pretty decent for the long side. All right, loading up my toss real quick. All right, I guess we're good here. All right. Greater bull market still looking good. Let's take a look at monthly maps just to check. We've seen this for a couple of days now. There's a little bit of interesting buildup here for the S&P. These really short-term costs of January. It's probably part of credit spreads, and there's a lot of them here. But you can see there's still that kind of buildup inside of here. It's still looking all right. The bull side market. Consumer confidence in 30 minutes. Jace is on top of it. Yes, sir. You are correct. So opening mean reversion, likely stay in mean reversion. So we'll see if that is the case. I mean, clearly no shorting still on my end. Oh, we need a new triple B. That's what we didn't do yesterday. Okay. I knew I was forgetting something. Okay, let's do it real quick. Okay, this is a technique. So nothing yet. I'm not doing anything yet. Okay. The easiest calculations to do, and it lasts all month. And you're done. Look how quick that was. 1369. So there for everybody. $13.69 on VIX. I'm gonna post that up in the Discord. Okay. Wow, 1369. Just watching the VIX just completely melt away is awesome. Okay, perfect. Okay, so not bullish market today, so if I get a good entry point. All right, good morning, friends. Hit that like button if you don't mind. This is the day that Matt stays out and eats a breakfast taco. Ooh, I should go make me some breakfast, huh? What do I have to do today? Oh, we're doing a training on the soft launch for the first marketplace vendor. We have a couple of platform white label clients. We've got our first marketplace vendor testing out with us. We got 50 of them lined up. Such a good live. Yeah, so we're opening above triple B. So anytime you roll into a new contract, right, which is the third Wednesday of the month, the Tuesday before is the night that futures market for Wednesday morning opens up. And that's when we do the calculation. So Wednesday morning, the third Wednesday of every month, is VIX expiration for monthly options. And it's usually a day that can induce some kind of activity, you know, as those options are expiring. You can create some runaway reactions or, you know, usually unusual activity that Wednesday morning. And this doesn't seem to be too bad. It can lead to it. So you roll into a new contract, and the new contract is in contango, which is a phenomenon that's unique to futures. Contango basically means you have two contracts trading at the same time, like that you're comparing. The month that just expired and the month that is you're rolling into. This being the January contract, put a big J there. This being the December contract, big D there. They looked exactly the same. Like, I'm just going to draw a similar thing. You see how this and that look exactly the same. It's just that each contract is traded at a different value. And for futures, you can trade December, January, February, March. You can trade all of them, whichever one you want. So you usually just compare the current month and the new month. Call it the front month now. And on Wednesday, the third Wednesday of the month, you roll into a new futures contract. You know, you stop looking at December, start looking at January. That's our roll. So when January is also following the same path, right, they look very similar. It's translated up a little bit, right? So you have December, while it's trading about 12, as it fell down, January is similar, but it's up at 14. So when the new month is above the last month, it's called contango. When it's below, it's called backwardation. Those are conditions that show that people, you can trade volatility. Like an example, I can buy a volatility product. And so if VIX is in contango, 14 versus 12, then what it's saying is last month, while last month was trading, people believed that December would be 2 more volatile than January would be 2 more volatile than December. Essentially, they're trading ahead of the market and trying to price in what January's volatility would look like. And that's why it's a contango. Traditional bull markets will be in contango, as people tend to buy lots of puts to protect their long positions. A healthy bull market will have VIX and contango. So it's very common. I'll just show you what they call, like some examples here. So like, here's an example, right? We've been in this bull market for a while. And you can just see that, like, each time you gapped up, it's not really a gap, but each time you're in contango and it bleeds out contango, bleeds out contango, then it bleed out contango. It's very common to be in that mode. Healthy bull markets will have a little bit of contango built. People are gonna, hedge for volatility just in case it happens. But for right now, we're above triple B, so that is starting out the new month this way. So what we're gonna do is we're gonna watch the VIX. Now that's a pretty healthy jump. But then again, we are at like 4-year lows. This is absurdly low at 12. So now we're back up here at 15, 14-ish. And now keep in mind, this is higher than where we are, but this is still lower than the rollover point at like the last 6 months. So it's still relatively low. And you can see how, like, you have some activity. It's going to try to trade down as this bull market continues. We are in that mode of being above triple B, which we used to say, we used to know that you're going to have some overshoots and pivots, and the market's going to have a little bit of extra volatility, which means in this mode, I'm not going to chase. So because there's some possible volatility, I'm going to wait and get a dip I want. And we have a consumer confidence number coming out. I'd love to take a 473 long. Easy sit out day. Yeah. Wait for consumer confidence, whatever. VIX has no warning signs here. All these things look great. Resilience is right on the edge and trying to fight. So it looks like the gap is holding, but the S&P is just too close for comfort right now, right? This is too flat and too choppy. I'm not going to get stuck in trying to trade something. I'm definitely not going to short this because it's limited here. I'm waiting for consumer confidence number to come out about 19 minutes. I'll probably take a long off a hedge pressure if we get it. QQQ also bull long up, and I think it just bounced on its head. But yeah, I mean, this market is not coming down, and I'm glad you guys are all really wise enough to see that. Do we have any? Oh, we do. Hold on. We have a yellow line here and I didn't mark it. So keep in mind, we have a 48.17 in the S&P. Dude, these lo-fi Christmas jams are pretty chill. I'm digging it. Although it's not my usual jam for the stream. It's slightly festive and it feels kind of neat. Jared, bro, you nailed it, dude. Y'all all nailed it. Y'all doing good. Don't forget to put the like on the stream, guys. Oh, Black Friday deal. Yeah, that's got to go. All right. Let me change that. So still, if I were to force myself to make a trade, it would be up on the bull zone to trade up. Resilience is positive, so maybe filling the gap. But honestly, right now, if you have yellow line, which is going to be resistance, you have a gap fill, which is going to be resistance. If I had grabbed that scalped alongside, I'd be closing out right now, exactly right now. Getting any resistance with the catalyst coming up. Opening here, it's likely to close there, so it's probably going to reject. I'm not going to short it though. You have resilience wanting to fill the gap at least. So you have two major resistances hitting up right here. This is resistance possibly, and this is resistance. So that's a pretty decent leg if when we're in that trade. Congratulations, it was decent. So I'm gonna observe this one from the sidelines today. Like, you guys are all picking up on it. Look at y'all saying sit out day and stuff. So you guys learning. You are learning from me. Good. bull long up liquidity map. And there's that open, blue open, which would be this leg, open to next resistance, open the next resistance, which is there. Easy peasy. All right. I need some coffee or something. I need to order my coffee. That's what I need. All right. Yeah, this was a hard one to figure out just because, I don't know, just because it opened pretty weird. Wasn't clean enough, but like I said, I don't want to chase with the VIX above triple B. So here's that resistance right here. See if we get anything. Now remember, it's always going to be some kind of volume at yellow line. We'll see if we get what we get. These are called illiquidity pivots. It took a little long. What's up, little blue? Ooh. All right, let me change this Black Friday deal thing because it's no longer a thing. Oh, that's a lot of text. Let's make it to where... Oh, I can add spaces. Look at that. Cute. Look at how smart I am sometimes. Oh, this is like, I'm gonna tell you something. Christmas jams are cool and I'm loving them and I'm digging them. However, they make me not want to do anything but just lay on the couch and stare at my Christmas tree. Drink coffee and watch Love Actually, Home Alone. I don't want to do any work. This is making me tired. Making me want to chill. It's been a... What's up, little blue? It's been a while, dude. How have you been? Or at least it's been a while since you said something in chat. They make you sad? Yeah, it's like not my usual pump. And I wish, you know, being on YouTube, you have to play like the copyright-free music. I wish I could just do anything I want, play any kind of music I want, and just like turn on some metal or something. Get us going. All I want in life is for it to be thunderstorming so I can drink coffee in pajamas and watch cheesy Hallmark movies. Barb is describing like the perfect life for like humanity. That sounds pretty wonderful, actually. All right, you guys, the bull long up trade, pushing higher. We're hitting a yellow line right here. Obviously, there could be some resistance. I don't even see a real easy second entry point. Let's just be honest. Thing is I think that this might be exhausted today. The market's still going to have a little bit of time fighting. It's still on the upside. I'd like to see a hedge pressure tap, but again, like, where does it go from here, right? Like, if resilience stays positive and hedge pressure, I might long it just to end up. But here's the problem. Statistically, you guys know, mean reversion is a likely destiny. We know if it opens mean reversion, it's likely to stay mean reversion. So I know that the long trade in this is likely short-lived. With an event coming up in about 12 minutes, those of you that are trading, you have a decision to make, don't you? Right now. Russell trying to trade lower. Russell's actually lower than yesterday's close at this point. So Russell's red, but all lights are green here. No alarms there and there. So in all honesty, if you were to like put a gun to my head and say, make a decision now, I'd say this is it. This is all there is today. You got it. You got it. If you didn't get it, then, you know, go make some hot cocoa and turn on some Hallmark movies. And that's what I feel. What do y'all feel? Do y'all agree, disagree? What do you think today is going to look like? What happens if we dip there and now it's a long? Well, where am I going to long to? You know, I mean, could I try that again? I think that at least today, if I were to take a guess, that's what today's going to look like. I'll be right back. Let me go get me a breakfast taco. Tell me your thesis in chat, guys. I want to see what y'all think. I got a breakfast taco. Oh, I need to order my coffee. Who here likes Nespresso? I'm gonna tell you something about Nespresso. It's amazing. What do y'all think? Tanmay thinks it'll be choppy today with a little upside. I think I agree. I agree. Feels like volume will reduce going to the holiday. I agree. Diego, probably bullish. You ever use EMA? And if not, why is it not the best option? Moving averages, I tend to, they're not bad. I just don't use them. I've kind of strayed away from trending type price action technical indicators just because they're kind of like recursive on price. Like price itself is a great indicator, and just an average of price is still showing you like, you know, price in a way. But people, you know, they're great. I mean, they're not terrible guides. I just don't use them. Our tools are superior. That's kind of why I just use our stuff. You think hedge pressure to half gap is a solid trade today? I think you're right, dude. Rowan, you've been here long enough to know that when you get a good run like this, it's kind of like questionable. Like from here, it could probably still trickle up. I would not at all be shorting us. Everything is just nice and strong. But I think if I took a long from here to here, I don't think it'd be worth fighting anything more. Right? You guys nailed it. Your plan is to wait till news comes out. And that's the smartest way to go. Wait, little blue, I skipped yours. I will be looking for small scalps after this. Balance. Yeah, I agree. Like small scalps, and that's because we'll be getting the volatility. You guys are so smart. Knowing the volatility will be present, which means you're going to get some B's to trade off of. So wait for dips. All right. Mix above triple B, volatility is possible. So wait for dips. You know that. Wait for dips, small scalps. I might take that small scalp. Agree. Your plan is to wait till news comes out, and that's really smart. Really smart. And hopefully the news can give us that little dip we want, right? Man, y'all are some smart traders. Y'all feel like the longer you do, you're starting, like, I don't know what your skill level was before you got here, but like reading what you guys are saying, y'all are all so smart at trading. You're getting it. You know there's volatility, you know there's news. You're like, aha, opportunity, right? 2-3 steps ahead. Hell yeah. Hell yeah, brother. I'm gonna get that. It's my Hulk Hogan impression. There's a meme I saw the other day. You guys remember like the Maury Povich show where they would sit down and it would be like, they would do the DNA test for the guy and the girl and be like, this is like these daytime trash talk shows. And he would come out and read the thing and goes, just FYI, you're not the father. And the crowd would go, ooh. And then they get up and like start punching each other and stuff. There's a meme with Hulk Hogan and sitting there and Maury Povich pulls out the thing and he goes, I'm sorry to say Hulk Hogan, but not everyone is your brother. Brother. Hey, brother. And he had like tears in his eyes after that. Sorry, Hulk Hogan, not everyone's your brother. That was a They're predicting the show, just calling everybody brother. Yeah, brother. I was a Hulkamania fan when I was a kid. I liked old classic wrestling. Okay. We get off caffeine finally after a bad run-in with ulcers. Oh shit. Dude, ulcers? How you feeling, man? That's hard. That's rough. I've had an ulcer one time and it is god awful. Never again. I had it one time. I think it was stress induced. Good Lord. All right. Yeah, Fausto, great customer question. Barb says we used to have a, hold on, wait. You used to have a fancy Nespresso machine when you worked at BlackRock. We drank 5 cups a day. You worked at BlackRock? You wanna stream? I can learn. I can learn from you. You should have a stream from the knowledge that you have. Welcome, Matt. Order history. Let's just click one button and reorder what I've bought before. There we go. I'm too lazy to shop. I just want to buy what I bought before. Shipping address, blah, blah, blah. Standard fee, blah, blah, blah. Continue. Put in my card. Oh, I need to add new card. Okay, you guys. All right, I'm gonna work on getting my camera up there today. That way y'all can see me doing dance moves and being goofy. Okay. All right, what do we got? Devo. Got your RS sub yesterday. We entered Edge Clear Cloud to open. Can't wait to become proficient in trading with Rocket Security. Basically gives you a trading plan every day. Devo, awesome, man. So Edge Clear, yeah. that's going to be for your futures data. So that's awesome, man. Welcome to the crew, everybody. Give a warm welcome to our new friend here. What do you got? Loved wrestling, still repelling in was always awesome. Dude, seeing repelling in, yeah. But like wrestling was like when I was a kid, dude, we just loved it. And like, you know, this was just like 80s kids. Back in the 80s, dude, I don't know what wrestling's like now. I couldn't name a single person, but in the 80s, dude, but that we didn't have Marvel movies back then. Like we had the X-Men cartoon probably. We didn't have heroes, right? Wrestlers were your heroes, unless you read comic books. The superhero movies and superhero shows were more goofy than they were awesome. I think the like Superman movie was pretty good with Christopher Reeve, but like you didn't really have, you know, like the Adam West Batman from the 60s was like goofy. It wasn't like a kick-ass dude. He was just awesome in his own way, but like he didn't have like that hero. So as a kid, like, you know, the wrestlers were your heroes. Had all like the action figures and stuff. We'd go see WrestleMania when it would come in Houston to the Summit where the Rockets used to play. The Summit is now Joel Osteen's church, but yeah, let's go watch all the time. Jesus, BlackRock, can we get a date on the Bitcoin spot ETF approval? Barb's gonna go undercover. So today is, there's no, did the news come out? Oh, here we go. A little pop on that. Let's read some data points I got through here. These are going to be the CV consumer confidence number for December. Existing home sales. The oil traders crude oil inventories come out in 3 and 30. Oh, wait, hold on. Oh no. The spinning wheel of death. Okay, we're back. She didn't know we had Micron's earnings today. This is the existing home sales number, the change in the analyzed number of existing residential buildings that were sold during the previous month. So this is a change in the number. So when the change is coming down, it means the curve is slowing. Still sales are going up. So if this is a change, right? So a change is a derivative of that. So if the change is going up, then the curve is speeding up. The change is coming down, then the curve is slowing down. So it's showing a period of decline. And this is just has everything to do with the cost of houses and the high interest rates. That's what you're seeing. And that's all that data point tells you. Consumer confidence. I love reading fundamentals because I just get straight to the point. People like to talk a lot about this stuff. I've been on some fundamental podcasts and these guys are super brilliant. These economists, man, they'll just go on and on and on and on. But as a trader, you know, it's kind of like you're not here to get a fucking dissertation in macroeconomics, right? Written. You don't need to be so ingrained into all the little pieces. It's more like how's it actionable to you, right? And so listening to people talk for hours and hours is not going to help you as a trader. So I kind of want to understand on the surface, what does this mean and how does it act, right? So the idea is like, I like to read news and say, what is this doing? What does the trend look like? Does it support like the thesis or narrative or what, or say the narrative, what everybody's talking about? And is this a big change? And I always take the assumption that Wall Street already knows all data and it's already priced in no matter what. So the answer here is, okay, well, there's high inflation, right? Interest rates are high and, you know, houses prices are going way up. You're going to expect sales to slow down and oh, it is doing what I expect. Okay. So the thing that would give me some high actionability, like, oh, there's a little burp on that data point. Well, that's just random and noise. There's nothing here that's alarming. It's still trending down. And I don't think that housing sales would have a lot to do with the overall feel of the S&P. It's just algorithmically the market responds to initial pressure. Okay, so is this really a big thing? No. And then the next thought is, what would make this a big thing? Well, what would make this a big thing is if the trend were to change direction, right? If the home sales started picking back up. Okay, and then you take one step further. is that a data point valid? Is that an excursion? Is that a one-time event? Like an example is you had a lot of people return to work on the unemployment things because of the strike in Chicago was over. So that was a blip in the data. It wasn't a trend change. So if this starts to trend upward, that's a good sign. But then you have to say, well, is that relevant data or is that good data? You can say, well, probably so. And then you're going to look for like a change in the trend. And that's usually all I look for is like state changes. I assume that the expectation is typically always priced in. I look for a state change very quick. Like as Sean is saying, stick your inflation. I agree. So like in economic data, like I don't, people always ask, and I always get props from people like, dude, you're so good at like this economic data. Like, where can I learn like how you learned it? I never learned. I read this. I learn what that is. I might Google that if I don't know to learn a little more. And I just look at data sets and I come up with an analysis. So I guess I learned how to do that in engineering school. To look at data and find relevant information in a data set. Like that's the skill set you learn in engineering school. So it's not, you can take any data set and start to draw correlations without even understanding the underlying part of it. And so the part I understand about how stock markets respond to news is it's pretty random. So what I'm usually looking for is a correlation between the data that I see and the overall greater market, bull market, bullish monthly map, things like that. So an overall bull market, you can see the stock market's very bullish right now. And the data, just example, this isn't really a strong correlating data set to like the S&P, but like, you know, this is just reflecting the inflation we're going to see. So let's try to be a little smarter. Instead of sitting here and talking about how this correlates to the S&P today, let's take it 3 or 4 steps ahead. How does this correlate with something that we know will affect the S&P in a broader sense? How about the Fed, right? The Fed's interest rate decision is going to be based on inflation for the most part. Okay, so let's predict what the Fed's going to do. Can we do that with this? Well, this is showing that, you know, sales are in decline, and it's likely because of the high prices and high interest rates. Okay, so the high interest rates probably has to do with inflation. Well, we had the consumer confidence number also come out, which could be a reflection of inflation as well. Measured the level of confidence in economic activity, can predict consumer spending. Like high inflation means your spending power goes down. And so a higher than the expected reading, and that's really why we bumped, is the CB number, plays a major role in overall economic activity. So it's like, as long as it's going up, it's a pretty decent sign. So in general, like the market is looking to improve a little bit. Right? Inflation, while there, at least in this data point, right? While inflation is still there, this is starting to kind of like level off. I mean, it's kind of like starting to slow down. It's here right about 4. Like this is just, so it could show that the inflation is starting to, or, you know, kind of tail off. And so one could say, okay, well, maybe if that's starting to soften up, and maybe the Fed's not going to be so heavy-handed with rate hikes next year. So one can make an argument like that. And that's just an example. That's not like my real thoughts, but that's what you would do with data. Is don't just look at it on the surface and say, well, ooh, we bumped up. Maybe it's a catalyst. The market's going to continue to rise. These data points, I think, are very loosely or weakly correlated to the market in general. But what they do is do exactly what I just said, is that traders are actually not moving on that number particularly. They're making those, like these algorithms that run, you know, these quant algorithms that run these data sets through their models will say, oh, okay, well, that's an indication that inflation's coming down. And it goes, well, that's a probability that when inflation's coming down like that, the Fed's less likely to raise rates. So let's along the fact that the Fed's probably going to not raise rates. So you take it 2 or 3 steps ahead. And so you start at the top, and it's called root cause analysis. You find like the one thing that's on the surface that you know behaves a certain way. Everybody here, I'm gonna play an experiment on y'all. Type into chat really quick, and I'm gonna prove something to you. Type your top 3 news reports or something that you know on the schedule that will always move the market, right? type like whatever news thing that comes out. Like, what are the top 3 things that'll always move the market really fast? Just type your top 3 really quick. But everybody type 3. What y'all see really quick, right? Y'all probably, there's probably 5 or 6 things, and y'all all are inside of that set. So that's, y'all proved it, to prove the point. FOMC, non-farm payroll, PPI, CPI, PMI, JOLTS. That's it. Y'all nailed, y'all pretty much are all on point. Those are the major effects. Okay. We know through observation, this is how you don't need and this is why you guys are here. You don't need a PhD in economics to understand. You start at the top and you dig backwards. We call it root cause analysis. It's such a cool technique. And I learned this in engineering on my first plant job. The market, you observe the market and you find out which days the market moves the fastest under different conditions, right? Bull market, bear market. And we all know you have like the same data that just always moves the market. And you know how none of you guys said like housing numbers, right? Because observation, you only see that. PPI, CPI, PMI, you know, all these other ones, right? FOMC, JOLTS is the big one, yeah. And non-farm, right? This is basically, this is probably the perfect set, right? Okay. So you know that those move the market and those come out periodically. So these like auxiliary data sets that come out, okay, market moves because of this. Well, why? Because this came out and hints at as a future possibility of something bigger. Okay. If you were to rank all of these at the top, we all know that the FOMC is probably the top ranking one. We know that the Fed Fed distinctly can move the market. Like the announcement of quantitative tightening exhausted a market and created a 1-year bear market. Okay. So the FOMC is probably the most important data point there is, not because it's the most important thing that happens in the economy. It's like the most important thing that traders tend to behave on. And that's kind of what you're trying to look for. One of the most important economic data points, if you were to tell me, it's the JOLTS. That's probably the most important economic point. Available jobs. Jobs are the machine core. Somebody's job is somebody's salary, which is somebody's spending, which is someone else's salary, which their job depends upon. And that goes in a giant fucking circle. And so the more jobs and the more spending, that circle speeds up and goes faster and faster and faster. And when there's less jobs and less spending, that circle gets slower and slower and slower, converting your labor hours into someone else's salary, because you got a job, you got paid, you got money, you spent money, they got paid. And the more you do that, they get raises. The less you do that, they don't get raises. And the even less you do that, they get fired. So that's the real important part of the economic, productivity growth. You need to see GDP. Oh, and GDP. Let's go here. That's also important. Now, again, GDP growth is always, for the most part, positive and only gets really negative in really nasty markets. But GDP is your telltale sign of a healthy economy. Okay, so the question is not that, like, let's just put housing in here on this auxiliary side. It's not that is housing what moved the market today. If the market moved today, you have to say, like, which one of these is housing predicting what they're going to say? So in Wall Street's like eyes, it's not this number that's directly affecting the market. It's this number that's probably hinting, aha, well, maybe the FOMC and maybe the CPI are going to be higher than expected. So what these algorithms do, these quantitative algorithms are always guessing what they think the report's going to be. They're looking at all the data that goes into it. The raw sales data, the raw whatever, all the factors that go into CPI, they can model that based on a lot of factors. And so any new news that comes out, the model adjusted. Say that this firm is like, okay, we've rerun some numbers. We think the next CPI is going to come out here. And the CPI has an input of like all these other reports that go into it. And so when this report comes out as a beat or a miss, the model for CPI will change. And then maybe their model will say, oh, well, CPI is slightly higher. And then that instructs their algorithm to say, oh, let's cover our shorts. And then that's why you get the bump. It's not usually directly affected by that data point. This data point is implying a shift in all of these models and expectations. And you're like, what is that? What do they do, all those expectations? Well, you know, like right here, they always have these forecasts, right? These forecasts are typically, you know, reportable firms that they actually report. You know, I don't know who does it. I think it was maybe the Wall Street Journal or somebody would like survey a bunch of different firms, like what is your expectation of CPI and FOMC? And so those expectations actually come from these major quantitative models that people are always modeling something. So in this root cause analysis sort of thing, like why'd the market move? Well, the market moved when the data point came out. Well, why? Well, not because that data point is really affecting 500 companies, right? It's housing affecting like a handful of companies. Well, the why is because this is built into a model, and the real market movers, which you and I, we all just played a game, observed, these are the real market movers. Somebody's models predicted that one of these is going to move in a very bullish sense based on housing, and they responded to that with buying. Does that make sense? So it doesn't really come, you don't have like a, you don't really have like that. If you're like on the surface of reading what this data is, you're going to make really bad trading decisions, because this didn't move on the housing number. This moved on somebody's model of CPI and what the Fed's going to do. And that housing number was an input to that. Probably on inflation, right? As that number is slowing down, just proves that inflation is still there. And it probably proves that the FOMC is probably not going to cut rates, but they're probably not going to raise rates either, because, you know, we have other data that feeds other models. And so because of that, somebody that's short probably is like, you know what, let's cover. And then they bought. Maybe they were expecting the news to be bad and it come out bad enough. So as a trader, you're never going to know what somebody's threshold of good enough or bad enough is. So when these news events come out, just treat them like they're random. You couldn't predict that that's going to go up or down. And I learned this through years of trading oil. Those inventory reports will come out sometimes. It was a build of 5 million barrels, and all of a sudden you think, okay, that's going to be bearish, and the market dipped and rallied. You're like, wait a minute, that's a bearish number. And then came out the next week, it was a draw of 2 million. You're like, oh, that's hella bullish. And it went up and up and up and up, then oil crashed. And you're like, wait, I don't understand. The number was bullish. Now, if you start to struggle with trying to correlate news to market action, you start to learn that you can't. And you start to say, okay, why can't you? And again, this is the root cause analysis. You keep asking why. Why can't I correlate what I saw in the data to what I saw in the price action? And you exhaust your avenues, and then the answer is you just can't. That's humans making choices based on what they perceive the market to be. And now you're just kind of at a brick wall where you have somebody's brain. You got to read somebody's mind. Why did you do that? Well, they're not necessarily telling you why. So you just take the assumption here is that these news events kind of have random action, right? Sometimes it's strong, sometimes it's not, sometimes this can sell off. And so what you have to do is you just have to say, okay, the behavior is random. The response is random. Where can I act on when that response comes out? So we have bull setups here to trade to there, and it pops up and goes out of the way, and one can say, oh, I missed that bull move. I should have gotten in on that. Well, you shouldn't have, because it would have been a coin flip. So what we do is, because we know those correlations, and we know that these reports go into other models, and it's so many degrees of separation from the actual price action, you just don't gamble into them. And then when you read them, you don't say, aha, the market was bullish because that number was bullish. There's so many layers to those models that that's not directly why. The market usually effectively prices everything in ahead of time or in real time. So in reality, what's probably doing is guessing what next month's reports are going to be. Like, these models are that sophisticated. They're not like, okay, inflation's bad now. It's like, oh, it's going to be bad in a month still too, or 2 months. So let's go ahead and get out of our longs or shorts or whatever. But then you can't predict that people are going to do that anyways. Yeah. So the answer is you just know where you want to trade. And then when the news comes out, you just kind of sit there and cross your fingers and hope that it goes to your entry point and then returns. If this is where price was before the news event happened, if you pass through this level ever again, like if you touch that today, then that news event was a non-event. There's no activity anymore based on that event. So if you are at this price before the news comes out and you have a quick knee-jerk reaction and you return to that price, then it was effectively priced in before the event, which usually happens. So like a trader, like a lot of times you'll see like market does this and then it dips and then it goes here and then sells off. Pretend this is a news event and it does that and that, and people say, aha, it's sold off because of the news event. Well, that's not correct at all. The news event neutralizes itself when you return to the price beforehand. There were sellers, there were buyers. The news event is no longer a thing. Now this is selling on something else, probably predicting next week's event or next month's event. So when you return to the same price after an event, the event was priced in before it happened. So buyers and sellers found each other in this range and then they met back to where you were. This liquid spot, you're back to there. Then this is called a non-event. And you'll notice when you trade long enough that most reports are non-events. So I learned to not chase or trade. Like, while this is just going forward, it's probably because the greater bull market is still bullish. And so again, bears are sitting there hoping for bad news and they're not getting it. And then they're finally just covering their shorts, still getting out of the way. And that's how I like to read these news events. And this, the longer you do it, the more you realize it's just going to be kind of like basic logic that traders are trying to forecast what the next report's going to say when this one comes out, or the next cascade of reports. How's this going to affect the CPI? How's this going to affect the Fed? And they're really acting on that. They're not usually directly acting on that news event, unless it's a huge excursion that beat or missed really badly. That could cause it. But usually people forecast it pretty accurately. As an engineer, how do you think about probability? I've read a lot of traders think of probability in the wrong way. What's your philosophy? That's kind of a general question. What do you think about probability of what? Sorry, I'm smacking in the mic here. Lee said, just got me over the top. Passed your first eval. Lee, let's go, baby. Congrats, dude. This has been months in the making, mainly from you not following rules and over leveraging on coin flips. Got more discipline and stuck to higher probability trades. Dude, you nailed it. Good job, good job. Patience. Here's the thing you'll learn trading. It's a game of patience. I'm known on Wall Street as being one of the most avoidant traders there is on planet Earth. I don't trade unless I like the move. There are people, when they're new, try to find a trade every day. Okay, what's the move today? What's the move today? What can I find a long, find a short? Or they're digging for a trade. I stick to one instrument that I'm good at, and I only trade that's something I like, and I'm very quick to sit out. The more that you stick to high probability trades, the better your success will be in this game. Guaranteed. Now, your goal is to find what is a high probability trade or not, but that's exactly it. The fewer gambles and coin flips you do, the better you're going to do as a trader in general. That's my advice. So if you have a thing that you do that's high probability, just wait for it. The higher your confidence, the harder you hit the trade. The lower your confidence, the less hard you hit the trade. And that's really the art form you guys are trying to practice as traders. Is the real art form is not finding where your entries and exits are. That's easy. Like here, I know that I have a possible entry here and exit there, yada yada. Market moved without hitting my targets. I'm just going to sit out because I've got nothing to trade off of. Okay, made that decision. But really, that's not the real skill of trading. Just like getting, three of a kind is not the real skill in poker. That part's particularly random. The skill in poker is betting. When to hold, when to fold, when to add. And so your job is your confidence. Anytime you see cards on the table, you poker players will see the cards on the table. They're calculating the odds already in their head. What's the odds of my success? They're also reading the table and looking for behavior patterns to try to enhance those odds even further. Oh, that guy always blinks twice when he's got a terrible hand. Okay, so my 60% chance just went up to 64% chance. Like you're always thinking like an odds in a way, right? So, and this is the same kind of game. There's a bunch of randomness. There's a bunch of stuff you can't predict. What is my confidence in the move? The higher the confidence, the bigger the bet. The lower confidence, the smaller the bet or fold. What's my confidence that from here, I've got a good risk to reward trade? Well, I don't know. I don't like it. So so I'll bet small if I do make a trade, or I'll bet zero, which is as small as you can go. As you get better at this, you'll realize the real skill set that takes you from not winning to winning is the size of your bets and the frequency of your bets. That is the difference between a winner and loser. There's probably a difference between me and you right now if you're newer. I'm not trading every day if I don't like something. Market moves and I don't say, oh, let me get in on some of that. Let me get some of that. I'm gonna miss out on the big move. Every single day is a big enough move to make thousands of dollars with a small account. You're never gonna miss out on anything. So if you don't get the setup you want with the high probability that you want, then sitting out or betting small is always a thing. And newer folks are here, that's what these alerts are for. These are confidence alerts in the tools that we have. So all the tools and liquidity maps and things are contingent upon confidence. Like I'll bet really heavy. If all these lights are green and yellow, I'm playing pretty heavy for the day. If the lights are yellow to red, I'm playing medium to small or sitting out. Like a bunch of red lights, I'll sit out. And so as y'all get better at this, you're gonna realize that when you strategically sit out, like right now, my strategies, I'm sitting out because I don't have any confidence. That decision right there is the difference between the pro and the non-pro. I watch streamers, I watch people always trying to force a trade or make a trade, and their results are all over the place. You're gonna do a whole lot of extra work and have a whole lot of frustration for a lot of random effects. It's just like, it's not worth it. If you don't get your high probability set up, you don't have to take the trade. Today, there's too many variables for me to feel confident in jumping in right here. You know, there's that yellow line also has a lot to do with why we saw some move there. But yeah, congrats, Lee. The Lee becoming more patient, taking high probability setups led to his success. This is exactly what I'm saying. The less you do, the better you do. Find the things you like, get good at them, and then scale your bet based on your confidence of that thing. If your bet was a BLU long and it moved up here and you're like, shit, I want to get in on that. Well, you're far enough away from your entry point. Even if you did chase it, you'd probably trade small just in case it fell, so that you can add to it there in case you got that move in to begin with, and then you can get the move. So, you know, clearly you're scaling your bet or entering at different places because of the circumstances around you as a trader. It's just like betting in poker. What are you talking? Makes sense. Rip rocket scooter, what do you mean? What are you talking about? Udry. Can you look at Amazon's monthly map? Yeah. No. He's the same guy that comes in here every day. There's like this vendor that sells like technical analysis junk, who literally obsesses with us and comes in every day on a different account and likes to say weird stuff. Section 75 of the Consumer Credit Act of 1974. Section 75. I'm eating the rest of my burrito. Imagine spending your time setting up new accounts. Here's a fun fact. There's some rando troll out there who runs a service to sell indicators on a platform. Even the platform banned them, and then ever since we call them out on that, they're here every single day. Probably trying to take notes and wonder how we grew 100 members for every one member they had. You got... What are you talking about? You got your appeal passed yesterday. That's amazing. We're I've never heard your name before, dude. Got your money back, yet you're still here watching the stream. No, like that's what I would do, right? I would ask for nobody got there. I hate this service. I need my money back, but I'm still gonna hang out in the stream the next day and watch the guy. No, it's a guy. There's a guy that's literally is a YouTube streamer that sits here in our stream on a fake account. But I think after like a decade of them streaming, I still only have like 30 people that watch them trade. And they stalk everybody. They stalk me. They stalk Tracer Matt. They stalk Patrick Wyland. They stalk all the big dogs. And I think they always wonder why their business didn't grow. And why they're trading, why their own platform banned them from their ecosystem and all that stuff. And here's the reason why. They ain't got no friends. And this is the secret of life. I'll give you guys a cool secret of life. Y'all want to know something cool about how to get ahead in life? All you gotta do is be cool and have people like you. If you're like, man, I want to get ahead in life. Working harder doesn't get you ahead in life. I mean, it does, but the real thing that gets you ahead is just having friends, which means just be likable. The more likable you are, the higher the probability is you're going to meet somebody that has an advantage that can help you or boost you or get you ahead, right? Network is net worth. Let me tell you what I'll tell you about this this troll person. I saw one of their videos one time, and they were like beating their chest to brag about some swimming pool they built with their trading gains or whatever. And here's what I saw in that video. I saw no friends swimming in that swimming pool. And I told myself, that's probably why they sit in my stream and troll. If I built a swimming pool, a fucking 1,000 people would come over the moment it opened up. And that's the difference between 50 members and 50,000 members. In life, you guys just be likable and just be kind to everybody and be chill with everyone. The more friends you have, the better your life will be. So that's it. That's really the secret of life. Just be cool. Just be likable. Everyone has a story. Listen to their story instead of telling them yours. And over time, you'll just realize doors will open up for you. Let's take a look. Amazon monthly map. Yeah, what good is a mansion if you throw a party and no one comes? Is that real success? Amazon monthly map still very bullish. Upstart, let's take a look really quick. I'll do a couple of these and see what you think. But in life, you should always just strive to meet people. Like here's the thing, right? If you have a God complex and you have a weird brain and you think everyone should worship you and you're awesome, you have this weird ego, you're gonna go out there and meet a bunch of competitors and try to, you know, talk shit to them and troll them, maybe whatever. And you're gonna realize that you'll be the one in last place. When I met all these other streamers, I was like, cool, man, I'd like to be your friend. Like, oh, wow, you're so big and popular. My thought isn't, okay, I got to bring this guy down. My thought is, I'm going to get to know this person. Seems like a cool dude. And you start to realize that in life, in a general sense, building your network is always a better course of action, even with your competitors. Here's the other thing, the trading platforms out there, all the competitors that build trading platforms, all the CEOs, they're friends. We chat all the time. I'm not like, ooh, these guys are my enemies. I'm not like weird sociopath like that. It's like, oh, this person is cool. Like, this is who I want to be when I grow up. Let me learn from them. Amazon looks pretty bullish. Bull side going up, bear side going down. I mean, bull side and bear side both going down. Bull side slipping down, bulls are longing more. Bear side slipping down, bears are exiting positions. So Amazon, or sorry, Upstart, just like everything else, is starting with bull pressure, like people buying dips, and of course shorts being squeezed. That's how you read it. The yellow line stays forever until that red line that created it disappears. Ooh, what happened here? Yep. All right. UV. Oh, CVNA. Let's check it out. Does the online video explain this? Yes, it does. Do I know anybody that uses Roxy to trade Forex? I don't believe so. We don't have anything for Forex. Chase was saying, like, how long did the illiquidity pivots stay there? And they stay there until the red line that created them goes away. So this one will be here until this goes away. So in general, they always stay there until that. Like this red line created that one, this one created that one. So as long as these have not been touched once, these will always stay there. So we had a couple of, oh, actually, don't we need to make some new ones? Oh yeah, let's get our new ones. So we're breaking out, we need a higher high for this one. Okay, let's why is my settings not saved? Let's go back in time and get some of these. So we had a, oh, we have one here. Okay. So let me go ahead and mark this. I think it was from there. I don't know why I didn't do. I thought I did that one. Oh, I think not. I might have deleted it on accident. Yeah, so no trades today, but market's still bullish and not trying to short this. I just didn't get a good entry point. You know, protecting my capital is very important. And let's go here. Okay. Hey, what's up? What's up, Juan? How's skiing going out there, man? Listen for a hit the lift. How to make the DD band show up in your chart? If you have futures data, you should have them. So you need a futures data source. Our futures certainly comes from EdgeClear. I mean, from CQG. EdgeClear is the broker we use. If you click the button for your first time, it'll take you through a series of steps. If you have a brokerage account, then you get your futures data. That's how you get them automated. Ooh. I'm super excited about the marketplace stuff. I have no idea how excited I am. We have two major white label vendors already that are building their own platforms out of the Rocket Scooter kernel. We have our entire process we made, which is our server streaming, server-based black box calculation modules that calculate your indicators and stream them to the platform. That's our technology that we invented. And let's see, we have two major vendors. One of them's an A-lister, and when that's launched, it'll be huge. And we're excited to actually be building their platform for them. So currently right now we're building, I don't know if you guys knew this, we're building two other trading platforms on top of our own. We're building 3 platforms right now. 2 of them are for two other vendors. And so in our marketplace, you'll be able to host your tools on Rocket Scooter. You can host your tools on your own platform. We have custom Discord bots. We have all kinds of different features that we're going to be able to allow people to create and sell different technologies or trade room features or something inside of one centralized marketplace. Super excited. It'll be, in my opinion, the most dynamic trading marketplace, period. It's not just indicators on a platform. It's all different kind of trade room type services, call outs, alerts, text alerts, all different things. We have modules for those. And they can interact with the platform and cross interact with Discord, all kind of things. So I'm super excited about that. And Elizabeth says maybe that's why they have kids, because they have no friends. Yeah. CVNA has a monthly map slip that's the same way. Yeah. Yeah. So the way that you're looking at it is the way the risk is distributed over time. So between here and here, At this current price, you can see that, and this is a way you can read this. If you don't want to use the guide, you want to actually use a little logic to kind of dig out what it's actually doing to understand why. Then here's the understanding of why. If this price were to stay flat for these weeks, then you have a huge bulk of calls that are in the money there. As you move into this week, you have even more calls that are in the money. And so as you approach each expiration, calls that are in the money are going to be, or the call seller is going to be forced to buy the stock, right? 100 shares per call. As you get to here, you've got more calls in the money than here, according to the risk spread, or more calls against the market, or like this, sorry, dealer calls in the money. So more forced hand buying just because you're deeper in the money. And that's about the same. And then even here, you're even deeper in the money. So somebody that's got the call at 35 that expires here is not likely to be acting on forcibly buying those shares here. But as you get closer to here, there's a higher probability that these 45s and 40s and 35s are going to start longing in here as well. So the closer you get to expiration and the deeper you are in the money, the higher probability that you're going to still find forced hand buying. So it just shows you that there are bulls willing to buy lower as the weeks go by. So this current price, it's just more bullish here than there because there's even more forced hand buying and more and even more. So that's how you read it. So the deeper into bull territory you are as time goes by, the probability is much higher that price just pushes away from this current level. Does that make sense? So that's how you read the monthly maps. Oh, I need to order my coffee. I forgot to check out. Oops. I'm saying you guys are ordering coffee, important stuff. Oh, so that's it. So when you're reading monthly maps, that's basically why it's showing that same kind of pattern. And so here at the same price, as you see, like the put walls, you're going to have, or sorry, the zones, you're going to have the bear side had the price has to fall even further to hit bear territory. So it's becoming less bearish. Less bearish means shorts are getting out of shorts. That's how that works. All right. So no guarantees call holders will, yeah, and that's it. No guarantees call holders will long an order of 100 per contract, especially if retrace happens, people start selling. Well, no, Sean, if that scenario, you're correct. That scenario was at expiration. So if you sold a call and you're now about to expire in an hour, that option's about to expire, you have to have 100 shares. You don't have to have 100 shares, but you will be assigned 100 shares to execute that assignment. So an example is if you have no shares and the buyer of that option, because remember, American style options can be exercised at any point, not just expiration. European style options only are exercised at expiration. So let's use the example of European option. Pretend that you can only exercise them, force the trade through at expiration. So if you sold the call, it's your prerogative over time to either neutralize that call by delta hedging, and you're getting the expiration. So maybe you might have 60 of those 100 shares or 40 of those 100 shares, but the moment it expires, you will have 100 of those 100 shares. If that person exercises to acquire those shares, you're required to supply them. So the market maker will force you to buy them from the open market and then sell them to the person that bought your call. So you are forced to buy the remainder at expiration. So in American style options, you're forced to buy the remainder at expiration or on assignment, which can be at any point in time, whichever happens first. And so again, it's the difference between what you're currently long and what you could be long. And so you assume that when you get closer to expiration, that there's just a higher probability of forced hand longing the more calls you have in the money. And you don't know the degree at which they're hedged or if they're fully hedged, but at expiration, they'll have the full batch. And you're right, they might not have 100 or even guarantee that they'll have 100. Does that make sense? And what bulls are about to... So like the idea is that because you're deeper in the pocket, as you get closer to this date, 50s, 45s, and 40s are more likely to be longing harder between here and there. Remember, as you get closer to expiration, you as the call seller are going to act, you're probably not acting here, you're definitely acting here, and you're probably going to act somewhere in here, to be honest, and each firm will do it differently. So somewhere between here and here, the closer to here that you get, the higher the probability the long will happen if price stays the same. So as you're getting closer to expiration, these guys in here that were no longer in the money because those options expire here are now probably going to start acting maybe inside of this week. So this week is, okay, well, let's start longing. They're going to pick up that long and pick up that long and pick that long. So that's kind of the philosophy, is that there's a higher probability of longs going longer between here and here because you have new zones that are in the money that weren't in the money here. They may be waiting to see if they don't have to, long that thing. But as you get closer and closer and closer, the probability becomes lower that you strike out of the money. Therefore, the probability becomes higher that you're longing into the delta and the other Greeks like theta. Right? Put selling to close would be long volume. So if you're selling the puts would be long volume. Try to wrap my head around that. The shape of the map looks weird. This map right here looks pretty consistent with bull side stronger, bear side weaker. It's pretty consistent. Now there's a little bit of junk in the middle because again, you're getting this transitional phase, but the bulk of it still has that same shape. Sell to close versus sell to open. Oh yeah, sorry, selling to close. Okay, so if you imagine this, put selling to close means you owned a put and you sell it to close out of the money. Therefore, the put's not going to be assigned any shares. So while you had that put open, the put seller to you would be shorting at a rate of delta. And if the price was going up, sorry, if the price is going down, they're shorting at the rate of delta, and you sell the put to close, and they would cover their short, and it would be cover volume, which is not long volume, but cover volume, which is bull volume. Same concept, but they're not longing. They would be, if they sold a put and they were short 40 shares, delta 0.4, and you sold the put to close, then they would cover their 40 short. Bull volume, yeah. So like, instead of saying like long volume, it's buying volume for sure, but the difference between long volume and cover volume, they're both buying volume, right? So for the higher probability is they were probably short at delta, and you sold your put to close and didn't exercise, so then they covered their 40 shares. Yeah, yes, correct, Sean, 100%. You nailed it. Good job, good job. All right, no trades today. Send this one out. I'm gonna let it kind of, simmer down here and just kind of do its thing. It's quiet, yeah. Kind of gonna sit out this one. All right, we'll see y'all later. See y'all tomorrow. See y'all at 4. Love you guys. Go enjoy your week. Go enjoy your day. Go enjoy your nice, cool, chilly weather. Have yourself some coffee. Just relax. All right, we got big things coming out. We're trying to soft launch our marketplace with our first test vendor. That should be, I think I'll be trained on that today, and we'll let you guys know when we make a little announcement on it. Again, it's just to test out the features of the marketplace. What we're building with this thing is massive. I mean, it's the Amazon for trading. It's going to be huge. The things we're going to have there just to enhance your trading experience. It's going to be a really, really, really cool thing for the industry, and we're excited to bring it out. So y'all are awesome. We love y'all. Thanks for supporting us. Thanks for being here. Thanks for being here every morning. Thanks for trading alongside the rest of your friends and family here, and we have a great community. We love it. We'll see y'all later.